Hi, I'm Kieran Oudshoorn. Welcome to About That, the show where we're all about explaining and expanding on the news. Andrew's away this week. Now, today's show, we're going to be talking about the housing market, specifically what happens when you default on your mortgage. It's a pretty scary thought for a lot of homeowners out there, but it's a scenario that's becoming more real for more Canadians. Just today, the Bank of Canada raised its interest rate to 4.5%. That's another quarter percentage point that it's going up. And it's the 8th rate hike in the last year, putting the rate at a 15-year high. Now, when the Bank of Canada rate goes up, it's not just a concern for people with mortgages. If you have a line of credit, a car loan, student loans, if you're planning to get a loan of any kind, those rates are going up too. And all of this pressure, well, it's adding up. CEOs of Canada's largest banks, they're warning that we may start seeing more mortgage defaults this year. In fact, Scotia's incoming CEO says that about 20,000 of the bank's borrowers could be vulnerable to mortgage defaults with rising rates. And there are millions of other bank customers out there whose mortgages are up for renewal this year, which means they could be facing higher mortgage rates as well when they go through that renewal process. Now, all of this, it means that there is less money to spend on groceries, on vacations, on clothing, and other living expenses. But at some point, there's going to be nothing left to cut. And that's going to leave people with very little financial wiggle room, which is all very scary. And with inflation still high, there's likely to be more rate hikes yet to come. So if you can't afford to pay your mortgage, what happens? Well, today I'm speaking with Victor Tran. He's a mortgage broker here in Toronto. Okay, so Victor, let's start with the absolute basics on this. Maybe you can explain to me, what is a mortgage default?
That is when a mortgage customer or homeowner has violated the terms and conditions of their mortgage loan. Mm-hmm. That could be missing a payment or for 30 days, 60 days, 90 days, failing to pay their municipal property taxes, demolishing the home, setting up an illegal grow-op, for example.
Right.
Those are the most common reasons, but definitely the most number one common reason is missing a payment.
Right. Yeah. Okay, so you were talking about missing a payment there, but just missing one payment, that's not going to immediately lead into you being defaulting.
You're right.
So what's the process that we would go through to reach that point?
Well, once a mortgage payment is in arrears, after 30 days, of course, the lender will reach out to the homeowner and try to collect. There will be late fees, of course, but a mortgage is considered delinquent or in arrears or default after they miss 3 months of consecutive payments, so 90 days.
Do people have to leave their homes immediately, or what's the next step that comes after that?
Well, typically, the lender will seek legal action to evict the homeowner. Once the homeowners are out, then they would go through the power of sale procedure. They'll list it on MLS to a realtor for sale. After the sale, they would pay the legal fees first,
right.
Any costs incurred by the lender, real estate commissions, and then it goes on to paying off the creditors. And then if anything's left over, it goes to the homeowner. But often, usually not much is left over.
Okay, let's pause for a moment. You heard the term power of sale. Well, you likely also heard the term foreclosure, and they're often used interchangeably. But there are some key differences. In a foreclosure, for example, the bank takes over the title on your property. That means the bank is now the sole owner, and you're entirely cut off from the sale process. And you get nothing from the sale of the property. Whereas in a power of sale, you're still the homeowner, but likely not for long. In that case, the bank has the power to sell the home in order to pay back any outstanding debts. And as you just heard, if there's anything left, then that will go to you. Now, in both the foreclosure and a power of sale, if there's not enough money to cover everything, then the bank can sue you for the remaining amount that's still owing. Now, all of these options are laid out when you sign your mortgage documents. It's interesting because you laid out here the sort of step-by-step process that this is going to happen. And it's quite a lengthy process to go through. And I'm curious how many people have actually are impacted this by each year.
Well, surprisingly, it's still very low. I mean, there's roughly about 5 million mortgages out in Canada. And the current delinquency rate, according to CMHC, third quarter 2022, it's 0.14%. That's less than 0.5%. So out of 5 million mortgages, that's roughly about 7,000 mortgages that are delinquent or in default.
And also, I think it's important to differentiate between the delinquency and the default, right? There's a little bit of a separation between those two items.
They're interrelated, right? I mean, once you're delinquent, that means your mortgage is in arrears for more than 30 days, and now you're going into the default status, right? So it's not a whole lot, 7,000, but even if we see an uptick of, let's say, double that amount, we're still lower than what the average was in 2017 to 2020.
So we were really surprised by how low that number was, given all the fear that exists around mortgage rates. But we need to remember that the rates aren't going down, only up. And what people can afford to pay for their home and what they could soon be required to pay, that's where things get concerning. And that's what we're going to get to in a moment. So here's the first example. All right, so we have a young married couple, first-time home buyers. The wife is a teacher. The husband, he works in banking. Together, they make $145,000 a year. And so when they purchased their home back in the summer of 2021, I mean, that's still during the pandemic, but before the housing market really peaked, they paid $750,000 for their home, and they put a minimum down payment on it of $150,000. Now, that means that they borrowed $600,000.
You got it. Well, back in summer 2021, when they first closed, they signed for a 5-year close variable at prime minus 1.3%, which was 1.15% back then. Crazy low rate. So their payments started off at roughly about $2,000, just rounding up a little bit.
Yeah.
Right. Now, fast forward 18 months where we are now, their current rate is 5.15.
Yeah.
Right. So their payment now is about $3,200 a month.
Really, what we're looking at is they were paying $2,000. That's about maybe what you'd pay in rent, although if you're lucky here in Toronto, and now they're paying $3,200. So that's $1,200 more a month.
Exactly.
So that's a sizable increase. When I think about if I were to turn around and be like, okay, looking at my budget that I keep each month, where am I going to find another $1,200?
Exactly. Yeah,
where does it come out of?
Yeah, you really have to cut spending in a lot of different places, right? Maybe no vacation this year. May have to downsize to maybe one car, for example. You have to cut your dining out expenses. I mean, there's a lot of places where you can cut expenses, but $1,200 is quite a bit.
Yeah. So let me give another example here really quickly. This one's a fictitious example, but I think it's valuable because there's a lot of people who are facing renewals for their mortgages. So let me walk you through it. We have another couple. They're a little bit more established. They've been in the market for a while. They've upgraded their home from a condo to a detached home. They did that in February 2018, which was apparently a pretty good time to be buying a house. They had $500,000 down on this new home that they bought. They had to get a mortgage for another $500,000 for a $1 million total that they're paying for. So let's say they are looking at that mortgage over 30 years at 3%. First, how much were they paying when they were locked in at the beginning in terms of their monthly payments?
February 2018, when they locked in at a 5-year fix at 2.99%, their payment was $2,100 a month.
Okay.
Right. 5 years has gone by, and now they're up for renewal.
Right.
They're renewing into a 5-year fixed at 5%, and their new payment is now $2,600 a month. So that's an increase of $500 a month.
Right. 500. So, that's less than the 1,000 that we were talking about with that first couple. But 500 is still a big chunk of money. I mean, that's all your food for a week, 2 weeks, maybe, depending on how you
Absolutely.
You cut it down. Okay, so let's think about this. If someone's facing the potential of a mortgage default, what are some of the strategies or some of the approaches that they can take to try to head that off?
So before they foresee any problems of missing a mortgage payment or going into default or arrears, talk to the bank that's holding onto the mortgage.
Right.
Talk to the mortgage specialist or financial advisor to come up with some sort of plan. Let them know that you may have difficulty making the payments. Again, the lenders are there to help you. Right? They're in the business of making money, not to foreclose on homes. Right. So they will work with you in maybe deferring your payments for a certain amount of time, maybe 3 months, 4, 5, 6 months even. When we saw that in 2020, right? Lots of payment deferrals. But it's important to talk to the mortgage specialist or your bank early before it's too late, because once that damage is done, your credit rating will take a big hit.
So about that big hit, it's significant. The credit score is what lenders look at when they're deciding whether or not to lend you money. And a default on your mortgage will drop your credit score by 50 points or more. If you're able to make up the payment quickly before the bank reports your credit score to agencies like Equifax or TransUnion, then you might be lucky enough to not have any impact on your score. But once there's a mark, it's going to be very, very difficult to refinance. Right. Well, we were talking, so this is a really interesting point because there's a bit of a spiral that happens. When, if you don't make a payment, then it impacts your credit rating, then it sort of continues to cycle out like that. So really, how important is it to make sure that you're connecting with your financial institution early?
Very important. I would say that's extremely important to do. Again, if the damage is done, then it's too late. You can't turn back time, right? And it'll be very difficult to borrow money going forward. So it's important to just keep your bank in the loop. Again, they're there to work with you. And if there is no option to defer payments, there might be some option to maybe increase the amortization to drop your payment, maybe refinance for a new mortgage. or worst case, maybe set up a second mortgage or a secured line of credit to pay your first mortgage for the time being. I mean, any temporary solutions may help, but it's very important to stay away from being delinquent or getting your mortgages due arrears.
Yeah, like good communication is super important.
Yes.
You know, it's one of these things where I think that sometimes maybe people step into taking on a mortgage, not realizing how long-lasting it can be, how difficult it can be to get out of this. But I really appreciate you walking us through all these different steps, really sort of laying it out, because not only is it a complicated process when you're in the midst of it, but also extracting yourself if it suddenly becomes not viable anymore. That's also a real challenge. So I really appreciate you coming in. Thanks so much for making the time.
Thanks for having me.
And of course, we're going to have more for you coming up on About That. So stick around after the break.